In this video, I want to discuss how value averaging works. Value averaging. In other words, you optimize your investments, your investment contributions. So value averaging is an investment strategy designed to optimize the timing and amount of investment contributions, aiming to achieve a target value over time. So it is a systematic approach to investing that adjusts contribution based on the performance of the investment portfolio, helping to buy more shares when prices are low and fewer shares when prices are high. And of course, you do that at regular intervals with a fixed amount of money. So these are the key concepts of value averaging. Number one is value averaging versus dollar cost averaging. Value averaging versus dollar cost averaging. Dollar cost averaging is more popular than value averaging. So while both strategies involve regular investments, value averaging differs from dollar cost averaging. With dollar cost averaging, investors contribute a fixed amount of money at regular intervals, as I earlier pointed out, regardless of the asset price. While value averaging, on the other hand, involves adjusting the investment amount based on the performance of the portfolio relative to a predetermined growth path. When it comes to dollar value averaging, the amounts invested varies based on what? Based on the performance of the stock. In dollar cost averaging, the amount is fixed regardless of the performance of the stock. So these are the differences between them. Number two is target growth path. Target growth path. In value averaging, investors set a target growth path or value that their investment portfolio should reach over time. For example, an investor might aim for their portfolio to grow by a specific amount each month or each year. Number three is contribution adjustments. Contribution adjustments. Contributions are adjusted based on whether the portfolio's value is above or below the target growth paths. So if the portfolio value is below the target, the investors make a larger contribution to bring it back on track. If the portfolio value is above is above the target, the investor may contribute less or even withdraw some funds based on his aims or objectives. Number four is risk management. Value averaging helps manage investment risk by investing more when prices are low and less when prices are high. These can potentially reduce the impact of market volatility and help avoid investing large amounts when prices are high. So essentially, when prices are high, you invest a smaller amount. When prices are low, you invest a bigger amount. Let's look at the strategy approaches here. Number one is establishing a target growth rate. Establishing a target growth rate. The first step in value averaging is to set a target. Set a target growth rate for your investment. This involves deciding how much you want your portfolio to grow over a specific period. Example, monthly, quarterly, or annually. What percentage growth do you expect from your portfolio? That will determine the amount of funds you are going to put in. Number two is monitoring performance. Regularly monitor the performance of your portfolio to compare its current value with the target growth path. This requires tracking the portfolio value and making adjustments based on the differences, on the difference between the targets and the actual value, between the target value and the actual value. That will determine the level of contribution you are going to make. Number 4 is a rebalancing. Periodically review and rebalance your portfolio to ensure it's aligned with your investment goals and risk tolerance. Value averaging helps with this by adjusting contributions based on performance, but regular rebalancing ensures that the asset allocation remains appropriate. So you rebalance regularly. So this concept, this particular strategy has its advantages and disadvantages. I want to look at the advantages of value averaging. Number one advantage is it reduces impacts of market volatility. Reduce impacts of market volatility. By investing more when prices are low and less when prices are high, value averaging can help mitigate the impacts of market fluctuations and avoid buying at peaks. You tend to buy at the bottom. You buy more at the bottom and less as the price increases. So number 2 is disciplined investment approach. Value averaging provides a structured approach to investing, which can help investors stay committed to their investment plans and avoid emotional decision making. Not only that, number 3, there's potential for better returns. By systematically investing more when prices are low, investors may benefit from purchasing assets at lower prices, potentially leading to higher returns over time. Normally, when it comes to investing, you make your profit when you buy. When you buy at a sufficiently lower price, you discover that when the stock appreciates, you make a higher amount of profit. But if you buy at a higher price, even when the stock appreciates, you will not make a sizable level of profit. The challenges here include number 1, complexity. Value averaging is more complex than dollar cost averaging and requires careful monitoring and adjustment, which may be challenging for some investors. Not all investors will be able to meet up with the complexities involved here. Number 2 is an increased contribution during market decline. In a declining market, value averaging may require making larger contributions to maintain the target growth path, which can be difficult for investors with limited resources. If you don't have enough capital, you may not be able to take advantage of buying into the bottom when the stocks are down. You may not be able to buy sufficiently to benefit from this particular strategy because of lack of adequate capital. Number 3 is transaction cost. Frequent adjustments in contributions can lead to higher transaction costs, especially if the strategy involves buying and selling of assets frequently. So the more you buy, the frequency of your purchase, of your transaction, will also add to your transaction cost. So who is it for? Actually, who can benefit from this particular strategy? Value averaging is suitable for investors who prefer a more systematic and disciplined approach to investing and are comfortable with monitoring their portfolio and adjusting their contribution regularly. If they have the time to be able to monitor their investment regularly and they equally have sufficient capital to put in, as at when due, then this particular strategy could be for them.